Good afternoon and welcome to the OBR's press conference for our March 2023 economic and fiscal forecasts. I'm Laura Gardner, Deputy Chief of Staff, and I'll be chairing today's event. I'm joined by the three members of the Budget Responsibility Committee, the Chair Richard Hughes, along with Professor David Miles and Andy King. In a moment, Richard will run us through a summary of the forecast that we've just published, after which the committee will take questions both from those here in the room with us and those online. If you're in the latter camp, you can submit questions at any time via Slido, which you can find via the link on our website. Before that, I should start by thanking on behalf of the committee, staff at the OBR, the Treasury and across government for their expertise, flexibility and perseverance in producing these forecasts. Of course, all of the analysis and conclusions continue to represent the BRC's own independent judgments. So with that, let's hear from Richard.
Thanks, Laura. I'm going to first take you through our latest forecast for the economy, and I'll then turn to what it and the policies announced by the Chancellor in today's budget imply for the public finances. Economic news since our previous forecast in November has been largely favourable in the near term. Gas prices, whose ups and downs have dominated economic prospects in most European countries since Russia's invasion of Ukraine, have fallen more sharply than we expected in November. As you can see from the chart on the left, markets now expect wholesale gas prices to more than halve from their quarterly peak of £3.50 a therm last year to £1.50 by the middle of this year. And as you can see from the chart on the right, this means that retail energy prices are now expected to fall below the government's energy price guarantee in the second half of this year. And the decision in this budget to extend that guarantee at £2,500 until the end of June means that next quarter's household energy bills will remain flat, rather than rising by 20%, as they would have done with a £3,000 guarantee. This alleviates a key source of financial pressure on both households and businesses, though market expectations for wholesale gas prices remain more than twice their pre-pandemic level, weighing on our productivity forecast in the medium term. The steeper fall in retail energy prices means that we expect overall inflation to fall faster this year, from a quarterly peak of 11% at the end of last year to 3% by the end of this year. But the earlier fall in gas prices and stronger domestic price pressures mean that we now expect inflation to oscillate around zero in the middle of the decade, rather than fall meaningfully into negative territory as we forecast in November. And inflation doesn't return to its 2% target until early 2028, when the output gap closes and real commodity prices stabilize. Another source of financial pressure on some households, businesses and the government has been the sudden rise in interest rates over the course of last year, both in the UK and around the world. Market expectations for both bank rates and gilt yields have jumped around in recent weeks, but are generally lower than at the time of our November forecast. As you can see from the chart on the left, at the time we took market determinants for this forecast on the 8th of February, markets expected bank rate to peak at 4.3% later this year, before falling back to 3% by the end of the forecast period, half a percentage point lower than we expected back in November. And as you can see from the chart on the right, gilt yields are also about half a percentage point lower in the near term, but largely unchanged from our November forecast at the long end of the curve. And both curves are well below the peaks they reached in the immediate aftermath of the mini-budget in September. Markets have remained volatile since then, with interest rates moving both above and below these assumptions in just the last 10 days. Lower inflation and higher pay growth help to alleviate some of the historic squeeze in living standards that we forecast back in November. So rather than falling by 7% over this financial year and next, real household disposable income per person is now expected to fall by a somewhat smaller 6%. But that would still represent the largest two-year fall in living standards since records began in the 1950s. Turning to what this means for GDP, we now expect a shorter and shallower downturn in the first half of this year. This is a consequence of lower energy prices and interest rates, reducing some of the near-term pressures on spending by households and businesses. From peak to trough, GDP now falls by just 0.5%, much lower than the 2% fall we forecast in November. And the economy then returns to growth in the second half of the year, and output regains its pre-pandemic level in the middle of 2024, 6 months earlier than we expected in November. However, these more promising near-term developments are set against the backdrop of more persistent structural weaknesses on the supply side of the UK economy, which have been exacerbated by recent shocks. The first is the fall in labour market participation since the pandemic, especially amongst older workers. The number of working-age people who are classed as inactive, that is, not employed or looking for work, has risen by around 500,000 since the pandemic, with over half of this increase among those aged between 50 and 64. Over half of the increase in this group is among those citing long-term sickness as their main reason for being inactive. In our latest forecast, some of this decline in the domestic workforce is made up for by a further increase in assumed levels of net migration, which we revised up from 205,000 to 245,000 a year in the medium term, based on the latest ONS projections. But we also assume a recovery in participation rates among the resident population, as NHS backlogs begin to be cleared and the policy measures announced in this budget take effect. Overall, we assume around a quarter of the current shortfall in economic activity relative to our pre-pandemic forecast is reversed by the middle of the decade. But this still leaves the total labour force around 3,800 people smaller than we expected prior to the pandemic. A second problem that's acted as a drag on the supply side of the economy in recent years has been a lack of investment on the part of UK businesses. As you can see from the blue line on this chart, the volume of real business investment has stagnated since 2016, due in part to a succession of shocks. First, the Brexit referendum and ensuing uncertainty surrounding our future trading relationship with the EU. Second, the shock of the pandemic in 2020 and the economic dislocations that it brought about. Third, the rise in energy prices brought on by Russia's invasion of Ukraine at the beginning of last year. And finally, the rise in interest rates in recent months, which has increased the cost of financing any new investments. All in all, that's left cumulative investment £340 billion, or 20% lower than that implied in our forecasts back in the first half of 2016. Against that economic backdrop of lower energy prices and a shorter, shallower contraction in demand in the near term, but persistent weaknesses on the supply side of the economy holding back the pace of growth in the medium term, the Chancellor's used his spring budget to take action on three main fronts. First, there's the aforementioned extension of the energy price guarantee, which costs around £4 billion next year. Second, a package of measures aimed at boosting the labour supply, whose costs rise to £7 billion by the fifth year. The most expensive of these policies is the provision of 30 hours of free childcare to working parents of children between the ages of 9 months and 2 years. Third, a further set of generous but temporary tax allowances on business investments undertaken over the next 3 years, whose costs peak at £9 billion in the mid-2020s. In addition to these measures, the Chancellor also holds fuel duty rates at their current level for a further year, costing him almost £5 billion this year and £2.5 billion a year thereafter, and he's added £2 to £3 billion a year to the defence budget. Taken together, these and other measures in the budget cost around £20 billion a year for the next 3 years. Thereafter, the temporary nature of the investment tax allowances means that the overall cost of policy measures drops to £10 billion in the final year of our forecast, when the Chancellor's fiscal rules currently fall due. Offsetting the £10 to £20 billion impact of these policies and their impact on borrowing is an improvement in the underlying fiscal position. This comes from two main sources. First, the improvement in our pre-measures economic forecast, shown in grey, which reduces borrowing by £25 billion per year. And second, a smaller boost to both the demand and supply side of the economy from the policies announced in this budget, shown in black, which reduce borrowing by a further £2 billion per year. Overall, the Chancellor spends around 2/3 of the £25 billion a year improvement in the fiscal outlook he's received since November from our more favourable economic forecasts. But that still leaves borrowing lower by around £12 billion on average over the next 5 years. The net result is an uptick in government borrowing from 5% of GDP in the last financial year to 6% of GDP, or £152 billion in this financial year. It then falls over the remainder of the forecast to around 1.75% of GDP, or £49 billion, as the economy recovers, the rate of corporation tax rises, and temporary measures like the energy price guarantee and business investment allowances expire. Turning to what this implies for the stock of government debt, compared with our November forecast, the level of underlying government debt is lower in every year, by around £60 billion in the final year. Unfortunately for this Chancellor, like all Chancellors since 2010, his fiscal rules hinge not on the level of that debt, but its trajectory, specifically whether it's falling as a share of GDP in the fifth and final year of the forecast. As you can see from this chart, While the level of debt is around 2.5% of GDP lower in every year of the forecast, it's only falling by 0.2% of GDP, or £6.5 billion in the final year. That partly reflects the fact that while borrowing in that year is £20 billion lower than we forecast back in November, adding less to the stock of debt, economic growth is slower too, adding less to growth in the denominator. The £6.5 billion of headroom against the Chancellor's debt falling target is down from £9 billion at the time Jeremy Hunt gave his first fiscal statement back in the autumn. It's also, as you can see from this chart, the smallest margin any Chancellor has had against his fiscal mandate since 2010. And it's around a quarter of the average amount of headroom Chancellors have had against the achievement of their fiscal targets over this period. Our latest forecast and the lack of any improvement in the Chancellor's headroom against his fiscal targets raises an important question. Why is it so hard to get government debt to fall? Every Chancellor since the financial crisis has made this his goal. But debt as a share of GDP is now 3 times higher than it was before the financial crisis, and we expect it to be higher by a further 5% of GDP in 5 years' time. What's going on? The answer is a combination of 4 factors. First, shocks. This series of crises that the UK economy and public finances have faced over the past decade and a half, in the form of the financial crisis, the pandemic, and now the energy crisis, have been unprecedented in their severity and frequency. Indeed, of the nearly 50% of GDP increase in public debt over the past 15 years, almost 9/10 of it occurred in just 4 years, the 2 years following the financial crisis and the 2 years following the pandemic. Second, headroom. The room for manoeuvre that Chancellors have typically left themselves against their stated goal of getting debt to fall was never large, and has now become vanishingly small by comparison with the scale of these shocks. Under George Osborne, the margin by which debt fell in the 5th year of our forecast averaged around 2% of GDP. That margin is now down to 0.2% of GDP in today's budget. Third, growth, where our medium-term expectations have gotten lower over time. First, because productivity growth disappointed after the financial crisis. Then, in anticipation of new trade frictions after Brexit. And more recently, because the pandemic and the energy crisis have reduced the labour supply and raised the cost of doing business. As a result, our estimate of nominal GDP growth in the final year of this forecast is 3.5% of GDP. That's down from 5.5% of GDP in our June 2010 forecast, 4.2% in March of 2016, on the eve of the Brexit referendum, and 3.6% in March of 2020 on the eve of the pandemic. That means that for a given level of debt, less can be borrowed without putting debt on a rising path as a share of a more slowly growing economy. And finally, interest rates, which have trebled over the past year on the stock of public debt, which is now approaching 100% of GDP. That's raised our forecast for the annual cost of servicing that debt to 3.3% of GDP in 5 years' time, which is more than twice the 1.4% we predicted just back in March of 2020. These higher interest costs add to borrowing and debt, and leave less for the Chancellor to spend on other things, be they tax cuts or new spending programs. It all adds up to a situation in which Jeremy Hunt today needs to work a lot harder than his predecessors just to keep debt from rising in normal times. And normal times have been hard to come by in recent years. Which leads me to the range of factors that mean the economy and public finances could end up in a very different place from what we forecast today. On the economy side, our forecasts are conditioned on market expectations for wholesale gas prices, which could increase the Chancellor's headroom by £4 billion if they fall back to pre-Russian invasion levels, or reduce it by £3.5 billion if they return to their post-invasion average last year. We also assume some recovery in the labour supply, including as a result of the policies announced in this budget. The Chancellor would have an extra £16 billion against his debt falling target if 500,000 more people return to the labour market, through either a reversal of recent trends or greater effectiveness of the government's policies. But if the downward trend in labour participation rates witnessed over the past 2 years continues over the next 5, a further 500,000 people could leave the labour market, and the Chancellor misses fiscal target. Our economic forecasts are also conditioned on market expectations for interest rates, which have continued to be highly volatile since their dramatic rise last year. If interest rates were 1 percentage point higher or lower, around half the rise in 10-year gilts over the last year and double the volatility over the past month, borrowing in the final year of the forecast would be around £20 billion higher or lower. On the fiscal side, risks also come from both the government-stated policies that are in our forecast and policy aspirations that are not in our forecast. Starting with the risks around stated policy, our fiscal forecast assumes, as Parliament requires, that the government goes ahead with its stated policy of an RPI plus 5p indexation of fuel duty next year, and RPI indexation in every year thereafter. This is not perhaps the assumption everyone would make, given that fuel duty rates have been either frozen or cut in every year since 2011. If those past actions prove to be a better guide for the future than stated policy, this would cost £4 billion by 2027-28. Moving on to risks around aspirations, our forecast assumes that the full expensing of business investment is a temporary measure ending in 2026. Making these capital allowances permanent, which the Chancellor said he would like to do if and when his rules allow, might cost sums approaching £10 billion per year, several billion pounds more than his rules currently allow. Another aspiration announced this week was the government's intention to increase defence spending to 2.5% of GDP, again as and when resources allow. Relative to the NATO 2% commitment, achieving this within our 5-year forecast horizon would cost £15 billion, but also put debt on a rising path in every year. In summary, the economic and fiscal outlook has brightened somewhat since our forecast in November. The near-term downturn is set to be shorter and shallower, medium-term output to be slightly higher, and the budget deficit and public debt to be lower. But this reverses only part of the cost of the energy crisis, which are being felt on top of the larger costs from the pandemic. And persistent supply-side challenges continue to weigh on our future growth prospects. Against this backdrop, the Chancellor spent 2/3 of the improvement in the fiscal outlook on his budget measures, providing more support with energy bills and investment in the near term, while looking to boost the labour supply in the medium term. This lowers inflation this year and raises employment and output in 5 years' time. But it leaves debt falling by only the narrowest of margins and from its highest level in over 50 years. So following another large revision to our fiscal outlook, this time a positive one, the main takeaway from this forecast should not be that debt will fall by a small amount in 5 years' time. It should be to focus on the continued uncertainty around our economic and fiscal prospects. We're still recovering from a once-in-a-century shock of the pandemic, while facing an energy crisis on a scale not witnessed in half a century. And the events of the past few days are a reminder that surprises can come from unexpected places. Managing the public finances over the next 5 years will, I'm sure, be as much about responding to these risks and shocks as it is about delivering the plans that have been announced today. And with that, I'll hand it back to Laura to manage the Q&A.
Thanks very much, Richard. We have plenty of questions online already, but do keep them coming. But I'll just check if anybody in the room wants to go first before turning to those. I can't see any hands. So we're going to start with a couple of quite broad questions, comparing our forecasts to those of others. So we have one question that says, you differ dramatically in your forecast for potential growth in the medium term from the Bank of England. Could you please comment on that? The delta is around 1 percentage point now. And a different question that says, why is your forecast for the Chancellor's headroom so different to Nice's? So, Richard, I don't know if you want to start. We might come to David after that, and then potentially Andy.
Yeah, so the differences in our forecast, they partly reflect the vintage of those forecasts. We've seen economic news improving over the course of this year, and in particular, energy prices falling, interest rates falling back. So part of the difference can relate to the fact that we take different, what we call market determinants or economic drivers of those forecasts. So part of it comes down to when you take a print of what the futures markets expect from energy prices and also what markets are expecting in terms of interest rates. We took those as they were coming down over the first quarter of this year, and that improved the outlook for demand. And it also has a small effect on potential output in the long run, because we assume that where energy prices stay high in the long run, that has an effect on our long-term productivity. We also take the view that we think households are going to dip into some of their savings to help manage through the squeeze on living standards, and that supports growth in the near term. And then in the longer run, we have a slightly more optimistic view of productivity growth by the time we get to the 5th year of our forecast. which is the fact that we think that productivity growth is not going to stay at its very low post-financial crisis level, but make some recovery once these shocks have worked their way through the system. I don't know, David, whether you want to add anything to that?
It is a big difference, actually, between our central forecast anyway and that of the banks. Richard has described some of the factors at play there. I think in the short run, the savings rate really quite a big factor, where we have the savings rate, at least when you exclude contributions to pension schemes that households don't really have a lot of control over. So the bit that's discretionary in the savings rate, we have dipping down to 0. That sounds extraordinary. Actually, it's not extraordinary historically. It's been quite common for the household savings rate to be that low. We think it's plausible that it will be that low. I think the bank doesn't think households will dip into savings as much, and so we have a stronger consumption profile than they do. Obviously, what we've done, which the bank in its last forecast would not have done, is take account of some government measures which boost the labour supply at the end of the forecast. So in the short run, the savings rate is a factor. In the longer run, it's the government measures. Plus, I think we've now used the latest ONS projection, central projection for immigration, which will be higher, I suspect, than the number that the bank has used. And in using the very latest futures market anyway, prediction of where gas prices are, that really has a meaningful impact on the productive capacity of the economy by the end of the forecast horizon. And again, the bank, because its last forecast was produced a little while back, will have implicitly used a higher gas price. So I think there are some reasons for the difference, but it is a big difference.
Thanks, David. We'll come to Andy on the NISA question. NISA is the research organisation, National Institute for Economic and Social Research, and I believe produced some estimates with rather higher estimates than ours of the Chancellor's headroom against his fiscal rule.
Yes, so as I understand the National Institute forecast, they have a differing view on the outlook for the economy than us, with a weaker outlook for real GDP, but a much higher inflation forecast, and therefore a higher forecast for nominal GDP. And that feeds through to a higher forecast for tax revenues. They then, from there, say that delivers many tens of billions of headroom against the fiscal forecast. So I think up to that point, the way the fiscal numbers have been worked out from the economy numbers looks similar to how we would do it. But then on the public spending side, it looks quite different. I mean, as I understand it, their forecast assumes that public spending remains precisely as it was in our November forecast, whereas about half of public spending is known as annually managed, and a very large share of that has either a contractual or a kind of de facto link to inflation. So if we had a much higher inflation forecast, we would see that public spending rise. And then in the real world, of course, departmental spending is subject to inflationary pressures. And if inflation was as high and sustained as the National Institute numbers, I suspect that would also, you would expect the government to reopen and raise those settlements. So I think the difference between the way we've looked at things and the way the National Institute has is, whereas they have come to the conclusion that that's tens of billions of additional headroom, I think if it were run through our models, it would much more likely come out as tens of billions of additional public spending and a rather smaller gain in fiscal headroom.
Thanks, Andy. I'm going to keep going with the questions online. If you want to ask a question in the room, wave at me and I'll hopefully notice. We've got a question from Arj Singh, who from the iPaper. He says, hi, are you able to say what proportion of the labour market or economic activity recovery is down to, first, the measures in this budget, second, higher than expected net migration, and third, other natural factors? And we have a similar question, which I'll group with this one, that says how much of the upward revision to your forecast is due to now assuming higher immigration? So two connected questions on labour supply there. David, would you like to go first on that one?
Yes. I I mean, the policy measures, we think, add something like 110,000 to the labour force in the UK. There's another effect as well, which is that not just on heads, i.e. how many people are working, but how many hours those who are already in the labour force work. And we think the childcare measure has a significant impact there from the expansion in childcare for mothers who are already working. So that's 110,000 heads in the labour force at the end of the forecast, plus an hour's impact from people who are already working. We've also increased our assessment of the likely levels of annual migration. So if you ask the question, how has our forecast changed since the last forecast we made in November? It's 110,000 more people because of the labour supply measures, much of which is childcare measure. The extra migration, I think, adds something like 160,000 by the end of the forecast. The combination of those two is enough to offset a reduction in our assessment of the starting point for participation, or effectively the size of the labour force. So instead of having the labour force lower than we'd expected before, we're actually higher by a net 140,000 relative to November. If you ask a different question, which is how much of the rise in employment between now and the end of the forecast, which is something around 1 million. So 1 million more people on our central forecast anyway are in jobs at the end of the forecast relative to today. If you stack that up against how many more net migrants are there in the UK over that horizon, taking account of the participation rate of the new migrants and the fact that a significant proportion are children, a significant proportion are going to be coming into the UK probably to study. And you ask a question, how does the number of net migrants stack up against 1 million more people in jobs, as opposed to those extra jobs being filled from people already here? Then I think the split is relatively equal, probably a little bit more on the numbers of new net migrants into the UK, and a little bit less of that 1 million comes from the population that's already here. It's maybe a 60-40 split, something like that.
Thanks, David. I think we've got a couple of questions on fuel duty next. The first asks, does it not make sense to assess the fiscal rules, including the likely continued fuel duty freeze, considering the temporary freeze has been temporary for more than a decade now? And a similar question, is the Chancellor only meeting his fiscal rules due to the assumptions that fuel duty doesn't rise and unrealistic spending plans? Andy, do you want to go first on that one?
Sure. So the main fiscal rule is met by a margin of £6.5 billion, and the contribution of raising the fuel duty rate with RPI from next year to the end of the forecast is £4 billion in that year. So the rule is met by a thin margin with the fuel duty indexation, and then by a wafer thin margin without. Is there more?
No, that's great, sorry.
And I should say this was the subject of a report of the Treasury Committee a few weeks ago, which raised this precise point, which is that we are required by law to condition our forecasts on the government's stated policies, which means that we have to put the government stated policies into our forecast. But they have raised this issue of the government has this track record of not indexing fuel duty but freezing it every year and then claiming they're going to index it in future years. What we've done this time around in our EFO in response to this recommendation of the Treasury Committee in Parliament is to show what the margins against fiscal rules would be if you actually froze fuel duties over that period. And so it takes about £2.8 billion off the 6.5. If that were to, it reduces the margin down to 2.8 rather than the 6.5. So still met, but the measure of Andy's wafer is 2.8 billion pounds.
I'm going to keep taking questions on Slido as a reminder. We do have someone in the room. Off you go. If you'd like to, I think we're going to get you a microphone and tell us who you are and then fire away.
So I'm a freelance journalist. You mentioned the impact of successive shocks in the past 15 years on the UK economy and therefore on public finances. But I guess a salient point is the striking lack of resilience of the economy and indeed public services during the pandemic. I'm thinking about the reduction in healthcare output. There were OECD numbers which showed that the reduction in knee replacements and hip replacements was far bigger in this country than in others. I just wonder whether you could comment on this lack of resilience, because that's another way of looking on this and maybe highlights structural weaknesses that are perhaps not considered fully enough.
So it is the case that the shocks that we face as an economy, both the pandemic and now the energy crisis, don't just affect demand in the near term, but we do assume that they have some scarring effect on the potential growth rate of the economy over the medium term. At the start of the pandemic, we thought that it was going to reduce output by around 3%. We've reduced that a little bit because we don't think it's had as big an effect on productivity as we thought, but there's clearly been a big effect on labour supply here. Some of it may be attributed to difficulties in the health service. I think there are lots of people looking into this question. I think it probably is too soon to draw definitive conclusions about why we've seen such a big increase in inactivity relative to other countries, because other countries' health services were also disrupted by the pandemic and to some extent still are. So I don't think you can draw any immediate and direct conclusions at the moment, but people are looking into this, and it's something we're going to continue to look at in the course of our work to try and understand what are the drivers of this rather unusual big rise in inactivity that we've seen here in the UK. But you have seen some big scars from the pandemic itself, as well as David was saying, from the rise in energy prices, which reduces just the productivity of businesses, which are particularly those which are energy intensive, because it's just raising their unit cost of doing business. And so one of the key drivers of our long-term productivity forecast is not so much what's happening to energy prices now, but where do markets expect energy prices to end up in the middle of the decade, once we see some kind of resolution to the European energy crisis, whether we find alternative sources of energy on the renewable side, or whether we find new ways of bringing gas into our gas-hungry economy, and at what price we'll be paying for energy by the time it's all over. At the moment, markets still think that price of energy is going to be twice what it was before the pandemic, and that leaves long-term scars on the economy as well.
Thanks, Richard. Another question in the room?
Thank you. David Robinson, Market News. You've again forecast that the saving ratio declines to around 0, which isn't a view shared at the Bank of England or widely elsewhere. And some people say recent data would weigh against that, if you look at bank deposits and others. And it makes quite a big difference to your forecast. Do you want to explain why you're still holding to that forecast and what difference it makes if it were not to pan out?
It's true, we have a lower savings rate forecast than many others, certainly than the Bank of England have had. Not sure where their current thinking is on that. I think, David, you weren't in the room a little bit earlier, maybe when I was mentioned one thing that I think is relevant here, which is that a zero savings rate, when you define savings as excluding contributions to pension funds where people don't have much discretion, sounds unusual, although historically it's not. I think I'm right in saying that for much of the period between about 2000 up to the financial crisis, so almost the first decade of this century, on that measure anyway, the household savings rate in the UK fluctuated around 0. I mean, it wasn't much above that. So it wouldn't be that unusual to have a savings rate that low. And I think there are some pretty obvious reasons why you might expect the savings rate to be low. The hit to real disposable income is very material over the next couple of years, something like 6% of people's disposable income. And our own assessment is that some of that is a temporary hit because we've got the price of gas coming down. It doesn't get back to where it was before, but it does fall off as you move through this year and go into the sort of medium term. And if households view it as a big, but to some extent temporary reduction in their disposable income, it's natural enough that those that can smooth a bit the impact of that, to some extent temporary hit on consumption, do so. So that really is the logic behind the lower savings rate than others, which we take the view that it's still a plausible and central forecast. Of course, it's also the case that with inflation, at least at the moment, we think it's going to come down sharply, at least at the moment, pretty close to 10%. Even though the interest rate people are getting on those deposits may be, 2.5%, that's a -8%, -7%, -8% real return. So there isn't a whole lot of incentive, certainly to save in the form of deposits with the banking system that are paying rates that are unlikely to be quite close to bank rate.
Thanks, David. You will stick with the room. Darshini.
Thank you. Darshini David, BBC News. You've broken out how the freezing of thresholds could impact the number of taxpayers, saying it could create 3.2 million new taxpayers. Does that figure just look at the thresholds and the current levels of employment, or have you taken into account your forecasts for employment growth? And also, what would that figure have looked like if we hadn't seen the CPI outlook change in the last few months?
I might chuck in another question from online that's very similar, and then I'm probably going to turn to Andy. This is, I think, quite a direct question. How many more people will be paying the top rate of income tax at the end of your forecast due to the allowance freezes?
Okay, let's take those together. So these threshold freezes in the income tax and national insurance system that run for 5 years are generating very powerful fiscal drag as they bring more people into the tax system and more people into higher rates. So the 3.2 million additional taxpayers is consistent with our final forecast, so it includes the employment growth, the latest CPI inflation numbers. The effect of changes to our forecasts for CPI inflation on this number have been very small since last November. I think last November's number was almost maybe 100,000 lower, so it's very similar. In terms of the higher rate and the top rate, so because the threshold between the higher and the top rate has changed, for the top rate, the additional rate, we expect 350,000 more people to be paying the additional rate at the end of the forecast than would have been the case without the threshold being reduced. And we expect just over 2 million more people to be paying the higher rate than would have been the case without the threshold freezes and the move in the additional rate. But because the additional rate threshold has come down, that means some people who were previously higher rate taxpayers at the top of the band will now be paying the additional rate. So if you take those two groups together, there's 2.5 million more people paying either the higher or additional rate.
Thanks. Next question, probably for Richard or David. Your initial estimate of the super deduction impact was a 10% boost to investment, which you brought down to 5%. How do you see the risks to your 3% impact of the new full expensing measure, especially considering the higher costs of investing currently?
The risks are clearly there, and it is the case that this isn't the first time we've seen capital allowances being given within the corporation tax system to try and stimulate investment. Last time around with a super deduction, which was actually more generous, it was 130% tax relief, so you were getting more back from tax than you were investing. We initially thought that would raise investment by around 10%. We knocked that down to 5% based on our latest estimates. I think it's important to bear in mind that we have had an energy crisis in the meantime. That clearly both reduces the return that you might get on your investment. What we've also seen more recently is a rise in interest rates, which raises the cost of financing that investment. So that was a policy operating in a relatively volatile and unstable environment. This policy is less generous in the sense that it's only 100% capital allowances for investment. So we brought down our estimate of its impact, partly because it's less generous, down to just adding 3% to investment per year, but also learning lessons from the first outing of this policy a few years ago in the form of the super deduction. So it makes a material difference to investment growth in the 3 years in which it's in place. But it's important also to mention that because it's a temporary policy, it only has a temporary impact on investment. So it has an impact on investment up until 2026. Then when it expires, investment in our forecast falls back in the final 2 years because the additional generosity for investment falls away and corporations face the full 25% CT rate on all of their profits. And as a result, in cumulative terms, over the forecast period between 2022 and the end of the forecast, the level of investment is really broadly unchanged in our forecast.
Thanks, Richard. The next question is from Sue Chan at The Telegraph. How much of the rise in the tax burden is due to fiscal drag? Given your assumption that the recent strength in receipts will continue, is it more powerful in this forecast? And also, why have you revised up forecasts for capital gains so much? Go to my right first.
Okay, so in the first question, so fiscal drag, it's not possible to split this out precisely, but the threshold freeze measures that we were just discussing are fiscal drag on turbochargers, and they raise about 1% of GDP by the end of the forecast. We have a tax to GDP ratio that between 2019-20, before the pandemic, and the end of our forecast rises by almost 5% of GDP. Normal fiscal drag would get you about 1% of GDP, and these measures add another 1. So in very broad terms, just under half. The other things that raise the tax to GDP ratio significantly are, of course, the corporation tax rise that takes place next April. Now, in terms of the specific question on capital gains tax, that's quite a simple answer in that capital gains tax is paid once a year in January, and the amount that arrived this January was significantly higher than our previous forecast expected. And it's a tax that has been, and we forecast to grow quite quickly because gains, the tax base, typically rise much faster than the asset prices on which they are made.
Thanks, Andy. The next question is from Alistair McQueen at Aviva, who says, the OBR forecasts closed on the 9th of March. I think he's referring to when we took market determinants for our final forecast. Before the collapse of Silicon Valley Bank, gilt yields have since fallen significantly. What are the implications of this fall for the OBR forecasts? Richard, do you want to start on that one?
Yeah, so it is the case that gilt yields have just been very volatile, really over the course of the last 3 months and including in recent weeks. Broadly speaking, a 1% rise or fall in gilt yields changes borrowing by about £20 billion in the final year of our forecast. So that's more than the £6.5 billion that the Chancellor has set aside against his fiscal target in the final year. We've seen gilt yields themselves jump around by about 0.5%, so about half of that £20 billion, about £10 billion up or down, looked at in isolation. I think it's important, though, to stress that you can't really just view these things in isolation. Interest rates can jump around for a number of different reasons. It could be an expectation of more inflation, it could be an expectation of more real growth, or it could be an expectation of lower inflation and lower real growth. We would also, when we to assess the impacts, taking all things into account, also have to think about what it would mean for the growth rate of the economy, what it would also mean for the nominal size of the economy, which matters for things like fiscal drag and the amount of tax receipts that you get out of the economy. But seen in isolation, roughly speaking, 1% either way on interest rates is about £20 billion. What we've seen so far is interest rates going up and then coming back down by about 0.5%.
Thank you.
Well, I've just looked at what the 10-year gilt yield is, which is all over the shop.
I thought you might be. I think you're going to give us a live update, David.
All over the shop. It's actually back where we conditioned the forecast on, pretty much, having gone up quite a lot until a few days ago and then come down really rather sharply. So actually, quite by chance, in terms of the yield on government bonds, they're now, on the whole, trivially different from the assumption we made in the forecast that we set some weeks ago. although until a couple of days ago we were thinking what the impact might be of gilt yields being higher, but for the moment that's a bit of a non-question.
Check with you again in 15 minutes.
Yes, that may work. Yeah.
Do wave at me in the room if you want to dive in. You do get the right to ask multiple questions for having joined us in person. But meanwhile, we're going to take a question from Anna Isaac at The Guardian. This might be one for you initially, Andy. What risk is there to your forecasts if the government does not clear the NHS backlog in line with its ambitions? Can that be quantified?
Yes, so I think clearly there are risks to both our forecasts about the labour market and our forecasts about spending on various parts of the welfare system that are likely to be linked to the NHS backlog. We have not quantified those links either on the economy or the fiscal side. But the things that one would like to know more about are the age composition of the NHS backlog. So I think many, if not most, are above working age. So you might think that the implications are greater for some of the fiscal benefit side of our forecasting rather than the labour market activity side. And then obviously you would like to link whether people who have been on the waiting list for a long time are actually those who are falling out of the labour market for ill health reasons or arriving on the benefit rolls, which have been rising very sharply. So I think it seems logical that risk, that if the NHS backlog were to remain higher for longer, that those risks would be more elevated. But no, we haven't been able to quantify, and I think we'd like to be able to quantify that.
Thank you, Andy. A couple of questions, I think, on the quite broad questions on the risks around our forecast now. So might ask you to start, Richard. One, you say a fuel duty freeze could add 4 billion to borrowing. If capital allowances were extended, they could add 10 billion. If defence spending was raised to 2.5% of GDP, it could add 15 billion. Does that mean that realistically the Chancellor's likely or stated political ambitions will leave him missing his borrowing and debt targets? So it's a question around the kind of policy-related risks to our forecast. And then a different question says, how do you expect public debt levels to go if GDP growth and interest rates do not meet your forecasts? And how does the government intend to sustain debt levels if those forecasts are not met? So I think that's kind of one question about the economy risk to our forecast and one question about some of the policy ones.
Yeah, so I think on the policy questions, it is the case that there are a set of policy ambitions both around making the investment allowances permanent as well as around defence spending, which are not in our forecast because they're ambitions, they're not stated policies. It's long been the case that hanging over and then there's obviously fuel, whatever the Chancellor decides to do about fuel duty in the coming years. It's always been the case that these ambitions have kind of hung over our forecasts as risks. People may remember that the previous Prime Minister talked about getting defence spending up to 3% of GDP. The current one is talking about doing it up to 2.5%. These ambitions are always there. For the moment, they're caveated as we'll do it when we can afford it. And therefore, we don't assume that it's going to happen now and plug it into our forecast because it's clearly not happening now. But we would do were the government to make that commitment. I think the second thing to say about policy ambitions is that there are different ways of meeting them. They don't necessarily need to add to borrowing if they are reprioritised within the overall spending envelope and offset other parts of public spending. So we also don't know whether this commitment to spend more money on defence is going to mean additional borrowing over the next 5 years, or it just means they're going to spend less on health, education, and other departments in order to accommodate that ambition. So that's the reason why we can't build it into our forecast.
And David, could I ask you to turn to the sort of economy-related risk question?
Yes. Well, at the end of the forecast horizon on our central forecast, I mean, the debt to GDP ratio is not much different from 100%. I mean, it's a bit less than that. So you have a 3 trillion, that's 3,000 billion pound economy. How many zeros? Hold on, I've lost track. A few thousand billion. And So the maths is nice because, the debt is about the same order of magnitude. So if GDP level were 1% lower and you wanted to keep the debt to GDP ratio where it was, you need £30 billion of the stock of debt. And if you had to do all that at the last minute, that's £30 billion of spending or on taxation. That's certainly a big number, which is part of the reason for our assessment that the probability that the government, with relatively little headroom, actually hits its target is a bit better than 50%, but it ain't a lot better than 50%, because 1% off GDP as a forecast 5 years down the road, either way, either on the good side or the bad side, is not an extraordinarily large hit. I mean, one remembers in 2020, the level of GDP fell, 10%? Thereabouts, we started the pandemic. So, a 1% deviation from the level of GDP 5 years down the road would not be a particularly large forecasting error, I'm ashamed to say. And of course, tax revenue and spending is sensitive to GDP. It's also sensitive to inflation, and the cost of government debt is highly sensitive to fluctuations in interest rates, and more sensitive to short-term interest rates now than historically it's been, because so much more of the debt effectively is short-term. So there are plenty of things that could happen on the good side or on the bad side that could take the amount of headroom well above the 6.5 billion or into negative territory. Of course, the government's got lots of levers to move between now and then if things start to move in certain directions. So I don't want to leave people with the impression that we think the chances that the government would hit the target are very low, because they can do things about it. But even relatively small economic shocks can have a pretty big impact on the fiscal situation and the stock of debt, which of course we've seen over the last 4 or 5 years, and spectacularly over the last 15 years.
Thanks very much, David. We've got time for a few more questions. We've got plenty online. I'll keep an eye in the room. Quite a specific question on public sector pay. I might come to you on this one, Andy. Do fiscal forecasts still assume public sector pay at 3% from next year?
Our fiscal forecasts are conditioned on amounts of spending in the departmental settlements, less so specifically on pay awards and so on. But I think it would be fair to say that, yes, our forecasts are still consistent with the amounts of resource spending that were allocated to departments in spending reviews, and that I think have been said consistent with 3 or 3.5% as an amount that can be paid. Now, the government's policy is essentially to wait for the pay review bodies to report before making decisions on pay awards for the year ahead. So, in a sense, we are conditioned on policy as it stands and awaiting news should it be different. So it's another of the many risks to the forecast.
Thank you, Andy. I have a question related to Brexit now. Can you say roughly how much of the £340 billion shortfall in business investment since 2016 you attribute to Brexit? Richard or David, want to go on that one?
I don't think it's possible to attribute, because the economy's been faced by so many surprises over the last 7 years. I don't think it's possible to ascribe particular shocks to investment to particular events. We've had the EU referendum, we've had the pandemic, we have the energy crisis. All these things have created an atmosphere of uncertainty about our economic prospects and how we do business both within the UK and also with our trading partners. So I don't think anyone can actually put a number on what has been the Brexit effect on investment versus the effect of the pandemic versus the energy crisis. It's certainly the case that investment has not grown in real terms since 2016, but it actually fell during the pandemic. It's now only just recovered to those 2016 levels, and it was down about 16% on the eve of the pandemic. And now it's down by about 20% compared to what we forecast the level of investment to be before the EU referendum in 2016. You can't ascribe all of that to Brexit. We've had a pandemic, we've had an energy crisis, and I think you can ascribe it to the fact that we've had a more uncertain environment for investment here in the UK than we had when we were forecasting back in the early 2016.
Thank you. Paul?
Just to follow up on that one, I believe the bank has a slightly lower figure for the Brexit impact on the supply side, but believes that it's come through more quickly than they'd expected. I'm just wondering where you stand on the timing of your 4% hit.
So I suppose there are three different assumptions that go into what we assume about the economic impact of our departure from the EU on the forecast. One is on trade, the second on investment, and the third is on migration. On investment, I've talked about. On trade, I think we'd say that what we've seen so far is more or less consistent with our assumption that over time, over a period of about 15 years, we'd see the trade intensity of the UK economy, sort of a measure of the openness of the UK economy, fall by about 15% over that period compared to what we thought was going to happen were we to have remained in the EU. If you look at what's happened to trade volumes here compared to trade volumes elsewhere in the world, UK trade volumes now are about 3% below where they were in 2019. In other countries, despite the pandemic, trade volumes are about 5.5% above where they were in 2019. So I describe that as broadly consistent with getting to that 15% number over a period of time. I wouldn't say that we're necessarily ahead or behind in terms of hitting that long-run target. The thing that has surprised us in our forecasts has been the level of migration since we left the EU, in that we were initially thinking that the post-Brexit migration regime would admit around 129,000 net migrants into the UK in steady state as a result of its operation. What we've seen is much higher levels of migration since 2020. The latest ONS numbers were around 500,000 migrants. Now, some of that may have been temporary. We took in a lot of refugees from Ukraine. We took in people from Hong Kong and other places. But we have over time revised up our estimate of what we think net migration is going to be from the 129,000 to, in our last forecast, 205,000, and then in this forecast, 245,000 in steady state as what we expect to be the consequence of the operation of this new regime. So there have been sort of two hits which we think are broadly consistent with what we thought when we did our forecast on investments and on trade. We've been surprised on the upside in terms of levels of migration. Those people, some of those people do join the workforce and they support output to the extent that they work.
Thanks, Richard. I think we've got time for one more question, and it's quite a broad one to conclude on. A challenging one. Don't you think your forecasts are overly optimistic? How does the government intend to pay for this new spending without increasing taxes in the longer term? So you can take that question and add any final words you haven't fitted in yet as well. Sure.
So we always compare our forecasts with those of other independent forecasters out there. And you can see on chart 2.23, which is actually the last chart of the economy chapter in our economic and fiscal outlook, how our forecast compares. It is the case that our forecast is just under 1% more optimistic about the growth outlook than the average. That does reflect, as David was saying, a number of factors. One is the fact that ours is the most recent forecast as of today. There'll be more after this. But the picture on energy prices has been improving over time. And it's been also the case that everyone's forecasts have been improving as it looks like energy prices are coming down, not just in the near term and in the medium term. So part of it reflects the fact that the news has been getting better about the UK economy over time. It also reflects, to some extent, the impact of the policy measures announced just today on the labour supply, as well as in the near term, the policy measures that stimulate investment. So that's another reason why we're a bit above other forecasters. And finally, this news on migration and what it means for the size of the population and the labour force in 5 years' time also pushes up our estimate of what we think potential output is going to be in 5 years' time. So that explains both differences that we have with the government's other official forecaster in terms of the bank, as well as one of the reasons why I'd say we're above what at the moment is the economic consensus. But one thing I'd underscore is the fact that all of us, and maybe this is my final point, that we are all forecasting in an incredibly volatile economic environment, one which forecasters haven't had to contend with in a very long time, which is that we are seeing interest rates triple in the course of a year. We're seeing energy prices go up 7-fold and then come back by half from that in the course of a year. These are huge changes which have very big macroeconomic effects, both immediately and on our economic and fiscal prospects in 5 years' time. And so one of the things which we always emphasize, and I think it's good that we've talked in this session about risks and shocks, is the fact that no central forecast survives 6 months, possibly 6 days in an economy like the UK's at the moment, given all the events going on here and going on in the world. These things are always a snapshot of the world as we understand it today, but the world is changing constantly. And forecasters are constantly having to keep pace with big shocks on energy prices, big shocks on interest rates. There's been also lots of news today about what's going on in financial markets. That will mean that our next forecast will also look different from this forecast because it will reflect how we see the world in the autumn rather than how we see the world at the moment.
Thanks, Richard. As I said, that's all we've got time for this afternoon, so apologies to the few questions online that we didn't get to. And I'll just wrap up by saying thank you very much for joining us today, and we look forward to seeing you at our next event in the summer.